Hello everybody, it's me the Boss Hog, and today we're going to look at what my portfolio has been doing for the last week, week ending the 12th of November, my buys, sells and dividends. Let's do it. Alright, so first up, back in the bedroom today. That's mainly just because it's slightly further away from my sleeping daughter, so sorry for the angelic glow above my head. But without further ado, let's have a look at the week. You can see from the table there in the sort of middle left, honestly a really flat week. It was very touch and go as to whether I was going to have a red or a green week. It finished very slightly green. It was sort of funny just because somebody in a Discord chat sort of challenged me about whether it was going to be green or red this week. And when I say challenge, I mean that in the most liberal sense of the word. There was no challenge at all, but for whatever reason I got incredibly invested in whether I was going to have a green or red week. So I spent an inordinate amount of time watching tiny movements in my portfolio, and yeah, just about managing to finish green. So don't do that, by the way. That's a waste of time. And but yeah, there we go. I guess I got weirdly competitive over it. Some interesting movements, but honestly a relatively quiet week, especially compared to previous weeks. You know, there were like holidays, leaves, you know, national holidays for Armistice and it's Veterans Day, I think the Americans call it. But you know, we have the 11th as well. So fine. Some of the highlighted movements here. EPD, this is my big pipeline, still my fourth largest holding, by the way. You know, I think it fell too far on going ex-dividend. It just completely overreaction, so I'm not surprised to see it climbing up. Basically, I held firm. If I had any more money, I might have been tempted to add it on the dip, but there we go. I've decided to include National Express here. I wouldn't usually include shares underneath 4% movement in a single week, but this is my largest holding by some way, so the minus 3% was material. But actually, to me, this is a good sign because basically my portfolio was able to absorb a £600 pullback on this minus 3% here. So that felt good, the fact I was able to absorb that and still finished up. I would say National Express have a put up or shut up deal deadline with a very large UK bus company for the 16th of November. I'm expecting this to be pretty volatile over the next week. No idea which direction it's going to move in or how the market's going to receive any news, but we'll see anyway. I expect this to be on this video next week one way or another. The big call out here actually was poly. This is polymetal, my gold hedge basically, and it really helped cushion the blow. I have a gold hedge for a reason. I think it's actually super important to have. And you know, poly was a bit beaten up. It tends to follow the gold and silver price because what do you expect? And for me, it's, you know, like a solid company. It's got good geographical exposure to me, as in, you know, it's like east in Russia primarily, as well as I think it's Kazakhstan. But it's also a very high yielding stock, and again, I like the gold hedge, and to be honest with you, it performed exactly how it's meant to perform in, you know, high inflation and commodity prices. So for me, it did exactly what it was meant to do, and it's really the first time since I've been investing, which, you know, I'm now into my 12th month, that I've been able to really witness what happens in, you know, like this is really high inflation, the market got a bit panicky, gold price went up, and so polymetal benefited, right? It happened exactly how it's meant to. It's very satisfying to see that. WH Smith here was on my video last week in terms of it's a big jump, and to be honest with you, it was a big jump for a weird reason, which I think the market just maybe expected something in the results. You know, there was no reason for that big jump, and the results were published and were basically in line with expectations. Like, it doesn't change my buy price in any way. I think it's still a good opportunity under about 16.20 for this. You know, the UK shops, the US shops, and their tech business all were profitable, but are smaller parts of their business compared to their travel, which is still loss-making. But again, like, all of the numbers were about where they should be, considering, you know, COVID restrictions and all the rest of it. And so I digested the earnings report, and like I say, I had no issues either way. It's not a buy, it's not a sell, it's just a hold for me. And it had the deserved pullback, in my opinion. You know, it didn't deserve to be running up and threatening like 1700. And now, actually, you know, I kind of would like it to stay under 16 just so I can carry on buying some WH Smith, because I think it does have a good core business. Disney, so a lot of people would have heard about Disney, of course. I have a fairly small stake in Disney, and interestingly, you'll see that I did sell one share at 176 before I had a bit of a pullback in a second. You know, I think, in fairness, I think Disney got a bit punished. I mean, it's a very expensive share, right? And so there's an expectation, and if you don't meet those expectations, you get punished. But in fairness to Disney, you know, they've been pretty consistent in their own expectations. And to me, it's like the market got maybe a bit ahead of it. So for me, although I wouldn't say Disney is a bargain at all in the 160s, it might be a buying opportunity, to be frank. So I might, I'm not 100%, you know, it's something I'm just dripping into slowly, because I do think Disney is a bit of a powerhouse. But those were the main movements anyway, and the reasons for them as I see it. Yeah, in terms of the trading front, you can see there on my left table very little movements, especially for me. But the eyebrow raising and the reason for the title of this video there is I decided to sell out of Johnson&Johnson. I had a very small stake in JNJ, and I was basically dripping my wife's ISA's dividend into it. So basically it was zero capital investment. But for me, I decided to sell out of JNJ because part of the reason why I wanted to put all of my divvy into it was because I view it as a long-term, almost diversified healthcare ETF, right? And well, kind of their split undermines that whole rationale. And to be honest with you, I'm kind of a little bit like fed up with this assumption that like if you split a business in 2 or 3, it just suddenly makes it a better business. Like, why? Right? Well, why is that? Like, the assumption is basically the business fights with each other and maybe doesn't have a coherent vision. Like, maybe you could make that argument for something like Unilever, right? Where you have like Lynx and Dove, or Axe, I think it's called in America for Lynx. You know, and they're like 2 very different brands, right? One's about like men being sexy and desirable, and one's about women loving themselves, right? Like, the conflicts, and then you've got all the other political stuff and all the rest of it. Like, maybe you can make some argument for splitting out some of those brands, but again, part of the reason why you hold these kind of consolidated groups is so, you know, when one part does well, the other part can do badly, and you know, kind of smooths everything out. And to me, that was kind of one of the perks of J&J. Like, yeah, okay, its consumer division is never going to set the world on fire, and you know, their healthcare division maybe could. You know, it's benefited from some short-term movements there. But you know, I kind of like that, and I've never once in any reading that I've done on J&J come across like, you know, their various parts of their business being a problem, right? Like, was like management teams fighting with each other? Was there a lack of direction? Like, not as far as I'm aware. And now it's like, okay, well, suddenly there's an expectation that splitting the business into 2 is going to release shareholder value. Like, why? I just, to me, it doesn't make any sense. I mean, maybe it does make sense. I'm just not aware of a reason to do it. And like, there's this automatic assumption that just breaking a business apart suddenly releases shareholder value. Like, I don't really accept that. So, you know, I just thought, to me, I had this business for a reason. I liked its diversification. Now it's going to split itself in 2. Maybe in the medium to long term, that will become a really great decision. But to me, I wanted this business because I viewed it as more or less bulletproof. And I really wanted, therefore, to hold it for years. And to me, like, just the split just undermines that, basically. Again, I got a little bit sensitive about this assumption. It's not J&J's fault, of course. But, you know, no one's really explained this to me yet, like, why this is going to be a good move. And to me, like, I just don't really like change for the sake of it. And until things become clearer, I just decided to sell out of J&J and put it into another healthcare stock, which we'll get to in just a second. 400 capital, again, added this week, another relatively uneventful week, and that is my standard amount. And just the 1 dividend this week, as I've mentioned previously. November is a very quiet month for me, and like this, like rolling quarter, you know, so like November, and then it's going to be February and so on, and my quietest month of that rolling quarter. So I only actually have 4 dividends coming in this month. This is my second one now. I have 2 big and 2 small. So this is my first of the small ones, and yeah, so it was what it was. And also, by the way, for Games Workshop, I now have 66 shares in Games Workshop. This dividend was just for 6.5, so in the future it'll be a little bit more. But to be fair, I'm not really into Games Workshop for the dividend. It's a growth stock rather than a divvy growth stock. So, but yeah, anyway, and that was quite a long summary. Let's get into my buys and sells next. All right, so I've not actually marked BMY green, but I probably should have. I've spoken about BMY before, which I guess is why I didn't. But this is where my Johnson&Johnson money went. Basically, I just moved it over. I still think BMY is really undervalued, and I can't stop buying it under 60. I think it's now my 2nd or 3rd largest holding. Can't quite remember which way around. I think it's my 2nd largest, actually. But now I have almost 350 shares, and I'm just about green. I'm under the $60 as an average buy-in, but I'm only up about 1%, which again for me feels really good because I think there's considerable upside in BMY currently. Next, we've got Genius. This is a company I've swung traded, I guess, quite a lot beforehand, so I've made quite good money off of this. I'm up nearly £1,000, I think, on Genius. And to me, I think anything under 17 starts to get interesting, and under 16.50, for me at least, is a buy trigger. So I bought 12 shares, not a huge opening, but you know, I'm basically planning on adding more under 16, which is actually just about where it finished on Friday at close. And then especially at 15.50, which is where I get really excited. I find early stage companies quite difficult to price. I'm definitely not an expert, but for me, I think this deserves a kind of low 20 price. And although I won't pretend like I'm an expert in that pricing, for me, when it gets into the realms of like 16, there's enough safety margin there. Like, the business is picking up business. It seems successful. It kind of aligns with a lot of my interests in like big data, gambling, sports. So it also kind of appeals to me from an interest perspective, and I think I understand the company basically. So even though it's like an early stage company, it kind of gets me a bit excited, especially because I think I can make money at this kind of level. So I had previously just kept one share from previous sales just to monitor it basically. I'll probably be selling that share in the future just because it sits in my tax efficient account and there's no reason for it to be there. So I'm basically moving it to my outside of my ISA with these shares, just some admin effectively there. So I decided to get into house builders, and for anyone who watched my month-end portfolio video, I was kind of saying that although I like the number of shares I hold, it was like 25. If anything, I kind of feel like I need a little bit more diversity, and one of the areas I flagged was construction, specifically UK construction. And again, for any non-UK residents, I just think it's a very simple, easy to understand piece of economics, right? The UK is one of the few Western developed nations that's due to see its population increase over the next few decades. We're not building enough houses already. The demand is still there, and there isn't enough supply. So basic economics 101 means the price is going to go up, which means that shareholders in construction companies should benefit. So I decided to buy two construction companies, basically. One of them is Persimmon. I still find it very hard to say, sorry. But PSN, that's the pound sign PSN, because I know there's an American one as well. This is basically just a very well-run housing company, construction company, sorry. It published its results. They were solid but unremarkable, and it got like a 5% fallback. I decided that was as good of an entry as I was ever going to get. Redrow I have actually owned before, but on a very limited basis and sold for a very modest profit. This for me is more like I don't quite want to call it a turnaround because it wasn't really like a failing business beforehand, but they're moving their business from a focus in the southeast where, land is very expensive, construction times are very slow, and they're kind of moving northwards where they don't have those problems. So even though I expect actually their revenue to come under a little bit of pressure just because the sale prices in the north aren't as good as in the south, I actually expect their earnings and their volumes to increase, and that's more or less what we were seeing, right? They published some results, and I got into Redrow before their results got published, and their results were very well received. And I think kind of probably even should have been more well received once you start to look into the details. So although I have very small stakes in both of these businesses at the moment, I'm actively going to be looking to add to them because I just think it's an important thing to have in your portfolio, an important thing for me at least anyway. So this to me is I recognized where I had a gap, and this is me beginning to fill in those gaps. And again, not a construction expert, but I liked the two. I've got like one super reliable, one improving, changing its business model, and hopefully, one or both of them will perform well for me. I bought more Hollywood Bowl this week. One stage is my largest holding. It's like a UK 10-pin bowling company primarily. It does have some like mini golf courses and stuff, but it's super well run. It throws off money when its stores are open, and it's due to publish a full year in December. I believe anything under 230 is really good. They did a trading update a couple of months ago, and it was kind of okay. They could have been a bit clearer in places, but to me, I kind of view the shares about 270, 275 as a fair point. So this has got enough upside for me, especially because I expect them to reintroduce their dividend in 2022, and again before COVID they were quite a newly listed company, I think 2016, but the few years that they did have, they were really performing very well, and I sort of expect them to get there again. They don't even have to be open that much to make money, and yeah, so this for me is like a 1 to 3 year probably holding, but I do like the brand. I like a lot about it, and like I say, to me under 230 is a really easy buy point. Last but not least, and this is a new position for me, I decided to get into S4 Capital. This is a fairly small marketing company, but it's led by Martin Sorrell, who kind of made a name for himself beforehand. He's got a Sir before his name as a result of it. I don't really know much about marketing. It's always seemed like a bit of like a dark art to me, to be honest with you. But I sort of trust the kind of arrogance, honestly, of the man. I've seen him do interviews and stuff. He's a right arrogant individual, but that's kind of off the back of decades of success, right? He's got pretty humble beginnings. He really knows his stuff, and it feels like the business he's putting in place is going to be a real challenger to more established players. Now, as far as I can tell, the share price fell back because they were talking about investing more to pick up basically large accounts. And yeah, I kind of get it, right? That's going to depress earnings for a little while. They're probably going to have to accept a bit of a beat down on margins. But to me, it actually signaled that the business is starting to get more ambitious. And so again, like this is a tremendously expensive stock. Even before the pullback, it was like a 40 PE. Now it's only a 35 PE, forward PE, by the way. So this is really expensive, and you have to kind of be willing, I think, to invest in this for at least the medium term to make it worthwhile. But again, I think it's like this is really backing the man. rather than anything else. I don't really expect S4 Capital to ever be a huge holding for me, but actually, again, I think it's like good to have exposure to that part of business, and it's like a growth side of the story, really. So although at the moment I have a tiny stake, right, this is a new position. I've got 17 quid in it on a 102 grand portfolio, but I would like to add to this, and I probably will be adding to it, especially under 7. Because I think like that forward P is expensive, but again, it's got a lot of potential as a company. It's really built itself well in terms of the big data, which is where I guess I do think I have some expertise. And marketing has always been a case of, well, I know 50% of my marketing budget's well needed, but what about the other 50%? Like S4 Capital has bought and built a lot of kind of digital focused businesses that are capable of kind of monetizing data in a way that maybe legacy players have been less on top of. So for me, again, like S4 Capital had a rough week, but I think the pullback is slightly overdone, and is a bit short-termist in my thinking. So that was the reason for those as well. Anyway, let's see what I sold. All right, so I decided to trim my share in Danaher. This is, again, another expensive stock, but a very fine company, but just to free up a small amount of money. And also a share in Walt Disney. In hindsight, I wish I'd sold my other 5 shares in Walt Disney, but I only sold 1. Both Walt Disney and Danaher I just freed up because I wanted to open a position, or I guess add to a position, but a new position outside of my ISAs in Genie. So that was where I got some funds for that. Games Workshop, I rounded down effectively, is what you're seeing here, and that was to free up money for my S4 Capital, so that's why I did it. So yeah, again, by the way, Disney, Danaher, and Games Workshop, these all form parts of my medium to, actually I think long term, holding, and these are sit outside of my tax efficient ISA accounts because, I just, it's really for balance. Like, these are companies that aren't really dividend payers, very low dividend payers. But they're like growth stocks that I think have a lot of potential. But again, in the UK, you get penalised on dividend tax a lot sooner than you do on capital gains tax, so it just makes sense for me to split my portfolio in that way. But by the way, I absolutely think that Games Workshop right now is a screaming buy for me under £100. It's a mid-sized position for me. And this is really just me trimming my stake rather than anything else, again, just to open a new position in S4. And yeah, I mean, I think I've already spoken about JNJ in my introduction. But if anyone, I think that will be the main contentious point of this. Everything else I said is, I think, relatively sensible, although feel free to disagree. But yeah, I think for me, like this assumption that splitting up a company just releases shareholder value, like some kind of like nuclear reaction, is a bit weird for me. And it's like sometimes when I see like companies like, oh, don't worry, moving into green tech, it's like, well, okay, so what? It's like, Disney suddenly now is a metaverse company. Well, okay, so what? It's like, until that kind of really translates into something worthwhile, then I don't really care. I don't know, maybe I'm just like a bit, maybe I'm just a bit contrarian, but I just didn't really want to do it anyway. So this is already a long enough video, I think, but I think I've laid out my position and dislike for this assumption. But again, if anyone has any questions, I try and be as transparent as I can in the comments and indeed these videos. Otherwise, if you've got any value out of this at all, please like, subscribe, and comment if you like. But that's everything from me this week. So thank you very much for watching. I've been the Boss Hog, and good luck with your investing. Bye for now, guys.